Hi, good morning. Good speaking to you for the first time in your new role, and from the conference as well. Your two-day conference has got a lot of interest from investors. How has the feedback been so far, and what's the mood looking like?
Well, thank you for getting me on the show. So, as always, we start talking to CNBC first.
Yes.
And yes, I think the mood on the conference is fantastic. We have had over 250 clients come in. Half of them are international clients. So it's a good mix of large international and domestic clients. Clearly, the mood at the conference is a bit circumspect. The environment outside of India is clearly a lot of uncertainty, a lot of international geopolitical issues. Here in India, we have gone through elections, we have gone through the result season, earnings growth is still to come. So clearly, I think the focus of investors is primarily on stock picking. Most of this year is fully discounted. So to that extent, I think the top-down story is well known and fully priced in the market. So where the money is to be made is bottom up, and that's where investors are focused on.
Okay, Sandeep, hi, good morning. So explain this dichotomy. We have had your conference and a couple of other conferences, and we're getting to know that the investor participation has been the highest that we have seen over the last many years. But over the last few days, what we have seen is consistent FII selling. Even if it's a bottom-up stock picking market, why are we seeing this kind of large FII sell number? Is it purely an EM phenomenon, or is it something more?
So just to answer your question, the flows which are happening and the investor participation which is happening is a bit of a lead and lag phenomena. So if a lot of conferences have happened, if a lot of investors are coming in, I would take that as a leading phenomena. And if these various investor visits and conferences are successful, the flows should come in the next six months or so. The numbers that we are seeing right now is mostly a lagging phenomena, a result of what's happened globally, what's happening with currencies in emerging markets, the kind of disappointments that India has had in terms of its own earnings growth and GDP growth and investment revival trajectory. So a lot of things that you just mentioned about negative flows are definitely there, and it may continue for the next couple of months too. But the investor interest remains high, primarily because India is still an island of growth. India is still an island of stability. India is still an island of hope. So to that extent, that's why we're seeing a lot of investor interest across all conferences. So
Right.
it's mostly a lead and lag phenomena.
Okay. By the way, Dr. Reddy's is slipping some more. It's now down close to about 2.5%. Its weightage in the Nifty is not much, only 1.5%. So it's not shaving off a lot of points from the Nifty, just about 2 to 3 points, but it's hurting sentiment. Sandeep, coming back to you, what you're telling all these corporates and investors who've come to your conference, how is 2016 going to be? Because this year has been a washout. The Nifty has lost 6% already, on a YTD basis. The earnings cuts continue. So how do you expect the equity performance to be next year for the index as a whole?
So we are looking at 10% kind of trajectory in earnings growth, and while you may be right to say that this, compared to the expectations, hope and hype of this year, it's been a -6% outcome till now, and therefore you would characterize that as a washout. But actually, if you look at what's happened in India in the context of the entire world, and especially the emerging market economies, India is still seen to be an island of stability, a large, big country with underlying structural growth drivers of at least 6.5%, if not more. So to that extent, I think next year, again, I mean, it depends upon what expectations are being set. I would set a 10 to 15% kind of earnings growth trajectory, and we are already very conservative with a 10% kind of trajectory. So I think the room for disappointments from here on is definitely going to be much lower. And to that extent, I think the market should at least trend better in terms of overall outcome than the current year for next year.
Okay, so the room for disappointment is lower. There's some breaking news right now on Dr. Reddy, so I'm going to toss that across to you, Sandeep. More so because this year has been full of disappointments, in the sense the very same sectors that did well in the first part of the year, like pharma and IT, are starting to come off quite a bit in the latter half. What do you do with companies like these where the quality of the management is top class, but now there are some US FDA issues, concerns, financial irregularity concerns that are cropping up? Do you keep the faith, or do you start to get a bit cautious?
We like Dr. Reddy's, but our top pick in the pharma sector has been Sun Pharma. And as you correctly pointed out, both of these stocks have had major corrections recently. I think, in fact, these are opportunities for any investor who has more than a year's time frame to look at entering these businesses. I am unable to comment on the breaking news and the direct impact of that, but our analyst in the previous, is talking about over the last 1 month to wade through these issues which are happening in Dr. Reddy's, and still believes that we still have a positive rating on the stock. So to that extent, other than this breaking news, which I'm unable to comment on, we like Sun Pharmaceutical, and as far as the sector is concerned, we should be selective, because I think for the pharma sector, the event risk on US FDA is ever present, and we have seen a lot of companies go through that, and some of the remaining companies which were untouched are also now witnessing the same pressures. So use good managements and bad news to buy a stock, and that's always a wise decision.
Okay, just to carry forward that lead and lag point forward, Sandeep, since market normally is ahead of factoring in earnings growth or degrowth, by when do you think this texture of market of being only bottom up stock picking and not doing anything on index change, because that matters a lot for retail sentiment, that matters a lot for overall equity cult. By what time do you see a bit of a pickup in earnings, and when do you think the market should start to factor that in?
Well, we are talking about a moderate pickup in earnings growth, as I mentioned. We are talking about a 10% earnings growth for FY17. And we expect that to be picked up probably, once we see the full year of, for probably after March 16. So I would think that a lot of banks, a lot of companies will probably use the full year March 16 numbers, to kitchen sink. We have seen a bit of that happening in a couple of banks which used the last quarter to come up with some numbers which showed losses. I would think the full year of March 16, companies will probably again want to take a decision whether they want to kitchen sink numbers, and therefore the broader index rebound should happen once we go through the reporting season, which is probably after June of 2016.
Okay, Sandeep, just hold that thought for a bit. We need to really address Dr. Reddy's now, down another 5.
That for investors who hold on to this stock, it's better to wait and watch and wade through this entire tough phase. But what about for investors who don't have DRL? At what point does Dr. Reddy's start to become an attractive buy for the longer term?
Any 20% plus correction, any name warrants long-term investors to look at the stock and evaluate, whether this is an interesting point. Unfortunately, given that this is just breaking news and I don't want to comment on it without talking to our research analysts, so I'll hold my comments on that. But I think any rational long-term investor would look at any 20% plus correction in a name to seriously evaluate this. So therefore, I think it's definitely worth looking at any name and in the pharma sector which has seen these kind of corrections. But of course, we have to look at the full implication of breaking news, and if that has any earnings implications in the near term, and that needs to be factored in any decision.
Okay, indeed, 27% now lower for Dr. Reddy's from the highs, and that high was just 2 weeks back or 3 weeks back. So it's been a sharp, brutal, swift correction, as you can see on the screen, almost like an elevator kind of fall. But Sandeep, a word on IT. What's gone wrong with Infosys all of a sudden? You've seen a big decline in that stock as well, and for the overall sector as well.
I think people's expectations again keep running high. This is a sector, the IT sector will give you 12 to 14% earnings growth. Yes, there may be a better management. Yes, there would be some initiatives which will give momentum. But the overall boundaries of growth are now well set for the sector. So again, as in India, we thought that things are going to change dramatically because there's a change in leadership, and then now we realize that while things are happening on the ground, it's still going to be some time before the entire picture changes, transforms itself completely, and similarly with the company. So to that extent, again, it is more a question of expectations mismatch or expectations running ahead rather than any major change in with the company. And also remember that the sector can only deliver 12 to 14% earnings growth. You have to buy it within a valuation band, and once, if you are disciplined about buying at between a valuation band, you will tend to make money. But to expect the IT sector to be a major outperformer means that either the rest of the domestic economy is collapsing and the rupee is also collapsing, and that is probably the only scenario in which I see the IT sector being a major outperformer going forward. This is not the case for India. I think we have had a currency correction, but definitely less than most emerging economies. And to that extent, I would look at the sector as a range-bound performer.
By the way, the other pharmaceutical stocks are also now falling. So Lupin is down nearly 1%. From the highs, it's come off close to about 1.5% to, close to about 2% now, in fact, from the day's high. And Sun Pharma too has now dipped into the red. Sandeep, you earlier told us that the next year will continue to be a bottom-up approach market. Now, this year, you've had the likes of car makers like Maruti, a couple of these private sector banks like IndusInd Bank, HDFC do well. Though on the flip side, it was real estate, metals, some of the PSU banks which lagged. Which will be the sectors and stocks which will drive performance next year, and which would be the sectors which will lag?
We believe that the consumption theme should pick up. We have had a muted consumption scenario for most of this year. We didn't have a great monsoon. So clearly the bets are that the consumption sector will see a revival. And to that extent, we like ITC. We have had 4 years plus of very bad excise duty increases for ITC. We have seen now fall in excise duty collections for cigarettes. I would think the odds are that ITC will have a moderate increase in excise duty, and predicated on that assumption, we like ITC. If you go outside of the consumer staples, then we like private sector banks. We like IndusInd Bank. We like Yes Bank. So they are also broader consumption loan growth stories, retail loan growth stories. So to that extent, we like these plays. Even in the infrastructure sector, I think it's now time to look at it and still be very selective. So I think L&T at current levels will give you a good return from here on. So L&T after probably the full year results are behind you is a good pick in May, June. So these are some of the names that one can look at. Again, I think the real issue for investors is to look for moderate earnings growth stories of around 14 to 15% plus, and be very, very disciplined on valuations. I think the market can easily have bad days, and we can see another 4 to 5% correction near term. So use those corrections to buy in and be very focused on management quality and have moderate expectations of earnings growth. So the level of disappointment is contained.
Okay, by the way, keep an eye on the market. It's drifting a bit lower, and Tata Motors is the reason that we have seen the last bit of fall in the market. Tata Motors now trading at the morning low point. Sandeep, I'm just looking at your at top mid-cap picks from Macquarie basket, and two names that really stand out for me, Dish TV and TVS Motor. Considering that we have already seen quite a bit of rally in some of these names, do you think there's more room left in some of these stories, whether it's the two-wheeler story in TVS or the kind of consumption story in Dish TV?
For mid-cap names, the first thing that investor has to look for is the quality of the management and the underlying structural growth drivers. I think for both these names, we believe that the structural growth drivers are intact. Management quality is definitely good in the sector. So to that extent, yes, we continue to like those names. And again, as I said, that the market can trade off, and therefore the focus should be buying those names on down days and in periods where the market is corrected. So definitely be careful. If there's been a big rally in the last 2 weeks, then it's best to hold off, especially for mid-cap names.
All right, Sandeep, we'll let you go on that note. Enjoy the rest of your conference and enjoy your new stint at Macquarie as well. Thanks so much for joining us and giving us your views. That's the word coming in from Sandeep Bhatia. But getting a